Hello, everybody. Welcome to the session today. I hope you're doing well. Happy Thursday. Here in Utah, it's beautiful. We've got warm weather. There's a thing called the sun in the sky. It's one of the nicest days we've seen probably this year. So want to welcome you to the class today. Let's go ahead and kick off, shall we? And we're going to start as we normally do with our legal disclaimer. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So with all that being said, today we have a very special guest. So all the way from Australia, Stuart McPhee. We've been doing business with Stuart for a number of years. 2013, we launched his trade launch systems. He's a best-selling author down in Australia. He's a trading coach. It's been a while since I've actually hosted him in a webinar. So I'm pretty excited to see him. He does a really, really good job. I'm glad you're here, and I'm glad Stuart can be here as well. So let's go ahead and bring you on here, Stuart. How are you doing today?
Yeah, all good. Thank you.
What's the weather like down there? What time is it, first of all?
Just exiting summer, but of course in Australia we don't get snow anywhere except in a very small area. So
let me go ahead and put the presenter on to you. And it should pop up a message that says, hey, do you want to share your screen?
Yeah, all good.
Okay, I can see that. It's coming through well. I'll just get out of the way, I think.
Okay, very good. Thank you, Jeff. Thanks for the opportunity to speak with everybody today. I guess for those in Australia, it's a very good morning. Elsewhere, it might be a good afternoon or a good evening. Thank you for your time, and thank you for the opportunity from Metastock to present today. Just so happens that, what are we today? Friday in Australia, Friday morning. Last Saturday, I was up in Sydney presenting at, in fact, the Metastock event there in Sydney, where they had a really good crowd over the weekend, and I spoke there on Saturday morning. And just so happened the week before that, I was presenting at their Singapore event as well. So 3 weeks in a row, I'm doing some work with Metastock, which is great because, as you mentioned, I do have a long history with the company. Seeing I've been using your software since 1999, which, as I was saying in Sydney just last week, so crazily is now 21 years ago, which just sounds like a long time. Anyway, so it's great to have your company here this morning. I hope you enjoy it. Very, very simple presentation today. I'm going to talk about just a market update. Just go through just two indices, do an exploration or two in Metastock, and just talk about that for a little bit. And then, as well known as moving averages are to so many people, I actually just thought I'd want to present just my personal view on moving averages and the way I think a lot of people misinterpret them. I guess a couple of ways that I think people probably don't utilize them as well as they can. I know people dismiss moving averages because they are what people refer to as lagging indicators. They only respond to price action or what price is doing. Mathematically, of course, they have no choice. They do not know what the closing price will be next Friday to determine an average. So it's almost stating the obvious that they lag. But despite that, I think they can be incredibly useful, and I'd like to share with you a couple of those things today. Well, pretty simply, as I mentioned, I'm just going to go through a bit of a market update, and I also will talk the second half about moving averages. Now, if you are not familiar with the GoToWebinar platform, which is very, very well known and well used around the world, you will have access in that little control panel that would have opened up when you entered the webinar. You might have access to a questions area. I've got that open here, so if anyone does have any questions during the presentation, either Jeff can field those or make me aware of them, or I'll see them and respond to them if I can, because of course I am here to help, and it's my pleasure to be here, and it's great to have your company. All right, with that, let's get on with the presentation so far as the market update is concerned. Now I just have, hopefully that's coming through okay on your screens there. Looks like it is feeding its way through. So I'm just looking at two indices now, just letting you know I'm not using live data right here. I'm actually using static, end of day local data on my hard drive. So in fact, the Dow Jones trading, probably not far from closing right around this second, has traded today and actually fallen a lot. So if I was to have live data, there'd be another big red, bar down here. So notwithstanding that, obviously, we've got a fair idea of what's happening of late. And I also have the Australian ASX 200 index here as well. Now, I'm not telling you anything you don't know. If I was to simply, give you an overview of what's happened the last 2 weeks and what a lot of commentary do, they'll tell you exactly what's happened the last 2 weeks, which of course, and I digress here, of course, I often say to people, when you watch those commentary and watch, oh, this has happened and this happened, rarely do they provide you, I think, actionable information that allows you to make money. They just simply report what happens. Anyway, I digress. I just get that off my chest there. So I'm not going to tell you what's happened the last 2 weeks because I think that's quite obvious to everybody. But one thing a couple of things I will share with you, if I may, so far as a market update is concerned, is firstly, I've spoken about this particular indicator a lot. It's not something that comes with Metastock, but of course, with the indicator builder, it's very easy for you to take some concept, take some mathematical idea, and using the indicator builder, actually create your own indicator. So many of you will be familiar with the indicator builder, and you'll notice here I've got lots of different things that I've created for myself, huge number of things that I've created over the years. Where, as I said, it's just a mathematical concept or an idea, and using indicator builder, use the formula language and actually put it into an indicator. But one thing I will share with you right now is my volatility percentage indicator. So I'm going to apply this now to the, I've done that wrong. I'll apply this now to the Dow Jones Industrial Average, and we know that, of course, I'm missing a day. Now, of course, we just have a red line. I'll just adjust this a little bit. Oops, I'm going to go into the settings. If I can click on, oh, come on. Just when I need to, when I'm put on the spot and I need to actually get the properties for this line, I cannot. There it is. I'll make it a lot thicker so you can see it, but I'm also going to put in a horizontal line here as well at a value of 1.5. There you go. So there's my indicator. So the red line is the indicator, and obviously there's a horizontal line there at a value of 1.5. And if I just zoom right out now for all the history of the Dow Jones, which of course is considerable, you can see now that formula in context. You can see where it's being plotted over the years. What I want to do though is just bring into more recent time, excuse me, and now we can start to see that for the majority of time, this red line, this indicator, the volatility percentage, sits below that 1.5% level. You can see that, right? Just a quick glance. What you will also notice is whenever it is in fact above the 1.5% level, normally the market is falling. In fact, almost every single time you see the volatility percentage spike and remain above 1.5, above that blue line, you'll find the market is falling. So even back here to the early 2000s, you'll see the market just not falling as badly as it has previously, but sure enough, the volatility percentage for the majority of that time was above that level. You can see through the GFC, throughout 2008 here, you can see considerable volatility, bordering on ludicrous and stupidity. But sure enough, the market fell and the volatility was above that level. And any other time, just use this line here, any other time you've seen the volatility spike up, if you look down below to the chart, to the actual index, you see that it fell during that period of time. Even these two little ones here, more recently, if I just zoom in a bit more recently when it spiked above, the market was falling, and again, the market was falling, and of course now it's falling. But I guess that just sort of proves the idea that when markets fall, they do so at a lot faster rate than perhaps when markets climb. But more importantly for me, and this is purely my point of view on this and purely something that I do, and of course all of these webinars are designed to present you ideas and for you to go away and do your own research and do your own homework and validate whether this is something you should use, but one of the things that I use this particular indicator for purely on an index is to give me an indication of when to step away. I'll say that again, to provide me a signal of when I need to step away from the market. Because what we find is when the market moves beyond this blue line here, what's that telling us? It's telling us that the market volatility, not an individual stock, not those 3 stocks over there, we're talking about a broad brush market index. I know the Dow Jones only has 30 constituents, but it's still a market index where that particular index is moving at considerable rate, considerable levels, where the average move is now exceeding 1.5%. Now, of course, if this activity continues for the next few days or next week, this is going to spike up even further, because the way I've got this working at the moment is it's actually going back the last 30 periods of time, which is in fact the last 6 weeks. So it's actually going back to when it was up here above 29,000, where it wasn't that volatile at all. So it's catching up to the point now where it's obviously exploding in volatility. Now, why I say that is because of that volatility. I believe that is directly linked to risk in the market. And when we get to levels that are well beyond 2 and so forth, you're almost getting to the point, I used the word before, of stupidity. If you think about what happened in the GFC back a long time ago now, the markets were swinging back and forth considerable percentages, up 7% one day, down 6 the next, and back up 5 the next day, and then down 4 the next, and then back up 7. This is stupidity. I mean, individual stocks, if they do that, we sort of raise our eyebrows and go, well, there's something silly going on there. But for an entire market or a market index to do that, to me, I'm going to say the word for about the 7th time now, is just stupid. So for me, that's enough of a signal to say, just stay away for a sec. Let's just wait for all of that to die down. The market's not going anywhere. And if you need to step away for 1 or 2 weeks because of that level of increased risk, then I don't necessarily think that's a bad thing, in my opinion. If I also plot that same thing on the ASX 200, so that's the Australian index, I don't think the volatility is as great. So it's at the moment 1.25%. So it's getting there. Just add the 1.5 line in, make this a bit more obvious for you. So it is getting there, and of course it has, like other markets, gone above that level, like again in 2008. And again, it has crept above that a couple of times, a few times, and of course, what has the market done in that time? And then right now, it's certainly creeping back up, and that volatility is the greatest it's been in several years. So that was one thing that I wanted to share with you, that just looking at the market, I think, we all make up our own minds on what we want to do, and some people would lap this up and think this is fantastic, but they're probably well prepared, and if they're going to do well, they've probably done all this before, and they're well prepared and very disciplined, and they're very sure about what they do, as opposed to just trying to guess from one day to the next which way the market is going to go. The other thing I'll share with you that I do occasionally is my all-time highs and all-time lows. So if I just select this exploration here of all-time highs, and I'll change that to weekly, and I'll just scan the All Ordinaries Index constituent. So for those outside Australia, that's just a very long time broad brush market index, which I actually thought was going to die off when the ASX 200 came on board, but it didn't. It's just the top 500 stocks or thereabouts. So I'm just doing a scan now for the all-time highs in that group of top 500 stocks. There's about 2,000 on the ASX, give or take. So these are all certainly probably make up 90% of market cap, if not more, on the entire market. So in the last week, there's been 7 stocks achieve an all-time high. So given what the market's doing, it's actually pretty reasonable. And then I do the same thing for the all-time lows. Make sure it's set to weekly, scan the same group of stocks, top 500. And is there 7? Oh, no, there's a few more than that. So 7, 10, 20, 30, 40, 50, 60, wow, there's a lot. So these are all reasonable sized companies that in the top, in the last 1 week, last 5 trading days, have achieved an all-time low, never been lower than this before in their entire history. So again, from just a market, looking at the overall market, this is something I do occasionally, is I just simply look at how many all-time highs in the last week, how many all-time lows, and what's the relationship between those two. So when I see 7, and then I see, how many do I have here? A lot more, must be almost 100 there. That's considerable, I think. And that again just provides me, even without looking at the index, I can get a rough idea that, I don't think things are traveling too well for the index. So how does that affect me? What can I do about that? Well, if you're someone who does trade, both long and short, and you use some synthetic, derivative product, whether it be a contract for difference or something similar, to take both long and short trades, this simple measure here, this simple test may in fact alter your bias. Perhaps you might say, look, there's considerably more achieving all-time lows versus all-time highs. Maybe I need to be looking and shifting my portfolio to having a lot more shorts than longs. And if I have two very similar charts, but they're the opposite, one presenting a long opportunity and one a short, then perhaps that can factor in and be an influence there on, a lot more achieving all-time lows. Clearly the market's not performing too well. Perhaps I'll take that extra short position rather than loading up on more long. So that's also something that can be of use. Again, something I do doesn't mean you have to. Please go away and validate or disprove or prove that for yourself, because again, it's your money, not mine. So again, just to share with you that idea, that's something that I think there is 96 there. I noticed that there. So it's considerably more, isn't it, than the actual all-time high. So again, it's just giving me an indication without even looking, as I said, without even looking at the index. I've got a rough idea that perhaps the market's not performing too well. And interestingly enough about that is the market is near all-time highs, whether it be the US or Australian. And yet we have almost 100 stocks out of the top 500 having achieved an all-time low in the last week. That is considerable. I mean, that's significant, I think. So again, that's something you may perhaps want to use or so forth. Okay, if there's any questions about that, more than happy. I wasn't going to go any further. Personally, yes, I started in stocks a long time ago now, almost 25 years ago. I think it's the foundation. It's where a lot of people start off, but more of my time now is devoted to currencies. For the last 12 years, I've been spending a lot more time on currencies. I still certainly have an interest in stocks because my superannuation fund has them, and I do my analysis, and all the things that I'm sharing with you here is all part of the tools that I use for that. But I just thought I'd show you those couple of indices and a couple of little things that I use. Again, if there's any questions about that, please do not hesitate to ask. Okay, I'll just move on to the more sort of formal presentation of today, and I'm going to talk about a topic that has been well and truly covered over the journey, over the years, and that is the topic of moving averages and those lines on a chart and what value they can provide us. But before we do that, for those who have never heard me present before, I always like to just provide an overview of my sort of beliefs, and so you know where I'm coming from. So I'll just start very quickly with a slide on technical analysis. And this is not a heavy presentation or PowerPoint slide. I've got about 3 slides and that's about it. My view on technical analysis. So when I first started learning about the market, I won't bore you with all the intimate details, but my first real exposure to commentary and to doing analysis was when I was living in the US and being exposed to all the financial commentary on TV, on cable. Cable television was a new thing to me when I moved there. Hadn't Foxtel or anything like that in Australia. And so I was fascinated with all this financial commentary on the markets and all these people dressed very, very well talking about what was happening in the market. And I'm completely fascinated by this and thinking, because I'd taken an interest just before we moved to the US. And I thought, wow, this is amazing. These guys are experts. Look how well they are presenting, how articulate they are, how confident they are presenting information. If there is gurus around on the market, these are them, the way they are talking about the markets. And I thought I really need to, if I was very interested in pursuing this, I need to learn what they know. And I need to find out what they're talking about with regards to the fundamentals and results of companies and yield curves and all those sorts of things that they were talking about. I thought that's where it was. That's where I had to, sort of divert my energy and focus to learning more. When I came back to Australia and started getting very, very heavily involved, all of a sudden I heard these people talking about technical analysis. And they weren't watching little ticker codes running down the bottom of a TV screen, they were looking at charts. And that really got my interest. And the more that got my interest, the more it got my interest. It really resonated with me that they are looking at pure numbers and pure data and just very, very objective analysis. And it struck a chord straight away. And I also thought I was almost intimidated by the previous journey I was going to go on of learning all that fundamental. I all of a sudden realized, wow, there's just too much to learn. With technical analysis, I thought this sits well with me. That's where the journey started, and that was like 20 years ago. But I quickly realized that technical analysis is simply one approach. It's not the perfect approach. It's not necessarily the best approach. It is an approach, and it's an approach that someone can adopt and learn about and utilize and employ. It very much resonated with me. I love the clarity of charts. Technical analysis can be incredibly complicated, incredibly complex and mathematical. Check out the formula for the parabolic SAR indicator as an example. Some of these indicators, a Metastock has as many as any other software platform, software, can be incredibly mathematical, really, really deep down, and there's no way you would be able to manually, do the calculations. But of course, the software allows us, and really it was the software that was the genesis really of technical indicators, because before that you couldn't compute them, you couldn't do the calculations really. So the software really opened up this. You'll find a lot of technical indicators were created in the 70s and 80s, if you want to read back into the history of all that. Why? Well, all of a sudden we had the software, the ability to calculate all these and draw them on the chart. So before that, they didn't have them, yet people still made money, which is often what I say to people. I do believe in the simplicity, and I'm not going to, again, digress here and talk too much about simplicity. I spent a fair amount of time talking about that in Sydney and Singapore, and how for me, simplicity is just everything, and it's so important in what I do. And at the end of the day, regardless of what analysis approach you adopt, all you're trying to do is increase the probability or the chance of having a profitable trade. That's all you are trying to do. So whether you do all the fundamentals or do all the scanning through the Explorer in Metastock, all you are trying to do is increase the probability of having a profitable trade. I'm going to bring up one example from a scan I did not so long ago. Just get rid of this. I'll just go to, open up chart here, close all this up, and go to the I'm just fiddling around here. That's not the scan I want. I actually want, just go back to my altitude system and go through the all odds list, go to daily. And of course, with local data, this doesn't take very long at all. And I'll just open up this particular chart because I may or may not have an interest in this particular stock. Fisher & Paykel is the name of this company. So again, I like to zoom out just to provide some perspective. That's a pretty good looking chart. I just brought this up because it's a good looking chart given the current environment. What I was saying before is any type of analysis, whether it be fundamental, technical, or looking out at the stars, whatever it might be, all we're trying to do is on the right-hand edge of this chart, trying to determine what is most likely to happen now. That's all we're trying to do. What is most likely? What has the greatest probability from this point forward of happening? That's all we're trying to do. If we can determine what is most likely to happen, we then as traders speculate on that probability, and we speculate by opening a trade. And then we do all the most important things, of course, of managing the risk and getting out when it doesn't work out. And when it does work out, we manage that exit well and allow the profits to run, and we trail exits and all those sorts of other things. But that, to me, at the end of the day, is really any form of analysis is designed to increase the probability or increase the chance of a profitable trade. So if we then move into a particular part of technical analysis, and that is, of course, trends. I often say to people, I'm a trend follower, which I am. I'm also a technical analyst. I'm a trend follower. again, I just like the idea of going with where prices were heading. If prices were heading in a particular direction, I like the idea of actually jumping on board that and running along with that and going with that. And of course, it's so interesting, I find, that it's counterintuitive to do that. So often people find themselves intuitively, without any great deal of thought, seeing a price move up and thinking, what a great opportunity to sell, and vice versa. They see a price plummet and think, wow, what a great opportunity to buy. What a bargain that is. It is now 50% cheaper than it was 2 weeks ago. I cannot see a better opportunity than right now to purchase this. It's very intuitive to do that. So to tell people to follow trend, of course, is counterintuitive. It doesn't sit well with people initially. It doesn't make a lot of sense. Why would you buy something that's already a high price? Why would you do that? It makes no sense. You'd rather buy it when it's cheaper. And it's, you know, it's just ingrained in us. As I said, it's almost intuitive, subconscious thought about wanting to get a bargain and not pay too much for something. So the whole idea of, you know, simplicity of following trend is if it's going up, you want to buy it. If it's going down, you want to sell it, or certainly don't buy it. Yet obviously a lot of people do the opposite of that. But the other thing about following trends is I'm also not going to suggest to you that there aren't people out there. I'm doing all the negatives here. I'll start again. There are plenty of people out there who will trade against trend and who can do it very well. It does happen. I'm not saying it doesn't happen. There are a group of people who will consistently trade against trend. They'll trade pullbacks, they'll trade retracements in a trend, they'll do all that. But those who do it and do it well know exactly what they're doing. They're well prepared, they're very decisive, they're disciplined, and they know they have a system that works. No beginner trader fits that mold, not one. Yet you have a beginner trader with no experience coming in thinking that's how I'm going to trade. I'm going to trade it when it's high, trade it short, you know, go short, thinking it's going to fall any time now. There's a number of ways in which we can identify trends. Moving averages is obviously what I'm going to talk about shortly. Analysis of peaks and troughs, you know, where we have the major turning points, you know, the highs achieved or the peaks, and also the lows or the troughs, and trend lines. And I put in a question mark there. I never talk about trend lines, but in preparation for today, I thought if I'm going to talk about trends, I really should mention trend lines just once. And I put a question mark there for a reason. I'm not a big fan of trend lines. And I learned this a long time ago. In fact, I should just perhaps use an example of this. Just get out a drawing tool here. As an example of this, if I draw up through here, hopefully you can see that okay. I'll just make that a bit thicker. So we draw a trend line. We think, oh, wow, what a good uptrend. And I have seen this happen. I've seen this happen for real, live in front of my very eyes where, you know, and you'll have to follow me here, you know, if price was to drop down through here and actually go through that line there, I have seen this happen where someone will go, I still feel bullish about this particular stock. I still do. So I'm actually going to lower this trend line down to this point here. And it's still above the trend line. It's still working. It's still in an uptrend. And you know what? They're right. It is still really in an uptrend. But they've lowered their trend line. And I think, and I saw this happen. I saw someone do this thinking, oh, no, it's still pretty good. You know, it's still going up. And I thought, so what is that trend line doing for you if you're prepared to change it based on your actual beliefs on what this stock is going to do? Is it actually adding any value? And I also, when I saw this person do this, thought, hang on, this is way too subjective. Way too subjective. To me, what resonated with me with technical analysis was the clarity of the chart and just looking at pure numbers and how objective you could be. You could be incredibly objective. You could say, I want to look at all the stocks that in last 1 week have achieved a 12-month high. That's a very clinical way of looking at things. And you know what? You could buy 1 or 2 of those and sure enough, set a stop loss, set a good trailing exit, and it might work well for you. Certainly worked well for me over the years, but I just didn't like the idea of trend lines. I thought they were way too subjective. I thought if you're going to change them, sorry, I'm just trying to get rid of these lines there. If you're going to change them, then is it actually providing you any value? I'm not a big fan of them all. And also, it's almost sometimes a bit of convenience where you try to connect the most common points I mean, you know, 3 months ago, someone might have done this and drawn that trend line in there, thinking, oh, well, yeah, look at that point. It's up here now. I've now got a trend line. And, you know, what do we do now? The price has now moved away from this. So now what? Do I draw another one up through here? I never found any text, anyone presenting to me back in the day, really able to provide me a very clinical way of actually drawing them, as opposed to just drawing a line on the chart. Anyway, I digress. I spent way too much time on trend lines there. Moving averages, just moving into specifically what I want to talk about. To me, it just helps in smoothing out, you know, direction, smoothing out the price. Two main variables. It's one of the most commonly asked questions in presentations is what number moving average, what time period moving average. Amongst the, you know, sort of amongst presenters, you know, who you come across at different events and the like, it's almost a running joke of, did you get asked, you know, what moving average did you use? You know, what number was it? You know, almost a running joke of, you know, it's just a very common question. So I just wanted to, I guess, there's a few myths and misconceptions I think about moving averages, and I just wanted to share those with you today and just run through in Metastock a little bit, a couple of ideas. So not only is the time period variable and change, you know, is it a 2-period moving average or 21 or 50 or whatever it might be, but of course, and certainly within moving average, within Metastock, you're able to select the type of calculation. So whenever you apply a moving average on a chart within Metastock, the parameters are here. So you get to select the time period, that's the main variable. How many periods are we going to go back to determine the average price? And the other major variable is the type of calculation. Is it a simple moving average? Therefore, every value, if I select 18, every one of those 18 closing prices has equal weighting in the calculation of the average. Am I going to do a weighted moving average where they no longer have equal weighting? Now, all of a sudden, the current period and the one before have far more weighting on the calculation than 18 days ago or 17 days ago, or exponential where that's done with logarithmic calculations, which I do not understand. So, but again, it's still doing the same thing. It's providing a lot more weighting or emphasis on more recent data compared to the one that's 18 periods ago. So there's a number of variables to select. You can in fact move them back and forward as well, but I'm not going to talk about this with the shifts, but I won't talk about that in this particular presentation. So that's the first question, you know, people come across is, you know, what type of moving average do I use and what's the number? And I think the idea is what type of trend are you interested in identifying? If, like me, for my superannuation fund, you're more interested in the sort of the more medium term trend, and therefore I often use the parameter of 3 months. When I think about 3 months, I think of it in terms of 65 days, right? So roughly 21 trading days per month. So therefore, if I wanted to see what the trend was, excuse me, the 3-month trend for this particular stock, I would then put in a variable of 65 days, leave it as a simple moving average, make sure I can see it, and then I plot it on the chart. And then all I'm doing now is saying, right, 2 things I'm looking for. 1, the direction of the moving average, and is price above or below it. So in this particular case, moving average is going up, price is above it, therefore that's everything I want to see in a trending, you know, last 3 months trending stock, right? Price is above it and the line is going up. That's all I want to see. Now, no moving average is perfect. Some people will use numbers from the Fibonacci sequence. So they won't use a 65, they'll use the closest to that, which is probably a 55. Is 55 a Fibonacci number, I think? Yep, so they might use a 55 because it's a Fibonacci sequence number. They might use 34, 21, 13, 8, or 5 because why? Because they're Fibonacci numbers, excuse me. So people like to use those numbers for some reason for extra mystical powers or something like that. And of course, we can also use multiple moving averages and crossovers as well. Now, I wanted to share with you one thing that I don't think a lot of people know within Metastock, but within my formulas, and I'll share with you a formula in just a moment, because I have it over here in a notepad file for you, ready to share with you. So one of the things that Metastock allows you to do is, in fact, take the moving average of a moving average. So when I'm thinking in terms of putting this into an exploration, into the Explorer within Metastock, so I can go ahead and scan the top 500 stocks, looking for price above the moving average going up. The moving average going up, how do we do that? How do we tell Metastock that the moving average is going up? What I do is this. So what I'll do is I'll actually take my moving average again, and I'm going to take a moving average of the moving average. You know, how am I determining whether the price is going up? I'm putting a moving average on it. How do I determine whether the moving average is going up? I'm going to put a moving average on the moving average. So I'm going to grab my moving average from here, click and hold my mouse button down and drag down. Notice how the price information on this chart has changed color. It's now purple. What that means is if I now release my mouse button, this moving average, once I fill in the parameters, this moving average will now be plotted on the price. However, if I click and hold and move my mouse so it's now sitting above the moving average, you'll notice now the price goes back to red and green, and now the moving average is a different color. And now if I release my button, mouse button, the parameters I set in here, try to move this, the parameters I set in here will now be the moving average for that moving average. So I'm going to put it on a 10, simple, and I'm going to make it a different color so it's obvious to see, and do that. So now this green line, and hopefully you can see that okay, this green line here next to the red one is now a moving average of the red line. How do I tell if this is going up? Because the price is above the moving average. How do I tell if the moving average is going up? Because the moving average is above its own moving average. And using the formula language, I can actually do that quite easily in Metastock. In fact, I've got Word open here for you, just so I can make it a bit bigger for you. Just something like that. Something like that. This was not designed to be a formula lesson, but here is that first moving average. That's the language for a 65 period simple moving average. All I'm saying is I want that moving average to be greater than this moving average. And what's this moving average? This is a 10 period moving average of my main moving average, is that one right there. So that formula there will in fact allow you to say, I want that moving average to be going up. And again, I think that's critical because what I don't want is the price. I'll just get rid of that second line there. What I don't want is the price to be above the moving average, but in fact, the moving average going down, and there will be times like that. Just trying to find that, perhaps just back here. So looking right-hand edge of screen, perhaps, where the moving average is going down, but price has actually gone above the moving average here. So price is above, but the moving average is going down. So right this very point in time, I don't want to see that because the moving average is going down. So that simple formula would eliminate that, and you wouldn't see that stock come up in that particular instance. The other thing I wanted to share with moving averages is the selection, how much we focus on, the number. And I just wanted to share with you this as well. And it comes back to selecting the type of calculation. So the parameters here. So when I say to people with stocks, I always use simple moving average. Occasionally someone will say, oh, that's crazy. Why would you use that? You should be using an exponential or a weighted because you need to have the moving average react quicker to when price changes direction. That's what they'll tell me. So I just wanted to share this with you now, where if I put on a 13 period simple moving average, there it is, nice and close. Because it's a 13 period, so it's reasonably close to price. I'm going to put on another moving average here. I better make it a different color so you can see it and make it thicker. I'm going to make this one an 18 period, but it's going to be an exponential moving average, like that. And then I'm going to put on another moving average, and this one I'm going to make a 21 period, and this one will be a weighted moving average. And again, I'll change the color so you can see it. And there you go. Whoops, make it a bit thicker. Thicker. There you go. So I'll zoom right out to get some idea, and then I'll zoom in like this. Okay. So there's 3 moving averages on my chart. One is a simple, one is weighted, one is exponential. And I will be the first to concede that mathematically they are different lines. However, I'll be the first to challenge you on, yes, they're different mathematically, but from a practical, actually applying them to a chart, I do not see much difference in those lines at all. And my point being is, if you're going to say to me, you must use weighted, you must use exponential, that's fine, but I will find a simple moving average, which is almost identical to the exponential or weighted you want to use. It will just be a different number. That's all. It's just going to be a lower number, a smaller number. But it'll be almost practically, in practical terms, an almost identical number. But it'll be identical, to the line that you have selected with your weighted or exponential. I just wanted to share that as well, because I think, again, people can be a bit confused about, oh, do I use weighted because if it changes direction, the line will change, the moving average will change direction faster than that simple. Yes, but you're using the same number. You can change the number and almost have the same effect, regardless of the type of calculation that you use. The other thing that, of course, I went through this in the Metastock conference, both in Singapore and Sydney, that are part of I'll just select this breakout day here, the 14th of October. So, I often share with people, and I did on the weekend at the conference, my trailing ATR stop. Just need to adjust the scaling here. Again, put on the spot, and I cannot for the life of me click. There we go. That's better. Hopefully you can see that okay. I'll just make that a bit thicker again. There we go. So I always share this with people. That's my trailing ATR stop. So that's just hypothetically, if I was to buy in this breakout here, probably new 12-month high, no, probably even more, that multi-year high, buying on that breakout, we then can employ my trailing ATR stop, which allows you to remain in that trade and enjoy the trend, because it just keeps its distance ready to catch should the price decline. Even if you don't have access to something like this, and I'm quite open, with this, obviously it's definitely part of my add-on that Jeff mentioned earlier. But the other thing, an advantage of moving averages, moving averages, we talk about them being lagging indicators and the fact they trail behind. Well, guess what? A moving average, whoops, I don't want that indicator. A moving average can be naturally a trailing exit. So again, and I'm just going to randomly select here 45, simple, and we'll make that say green, a bit thicker. So all of a sudden now, a moving average, if we get into a stock, can be its own trailing exit, because by its very nature, if we have a very good, strong uptrending stock, it's going to trail underneath that. So in this particular case, I must admit, I've used this a lot, but I did actually randomly select 45. I was going to go with 50. I've selected 45 there. In this particular case, and I don't mean to curve fit, in this particular case, it's actually worked out just as well as my trailing ATR stop, in the sense that it's allowed you to remain in this trade even when it fell back down below here, didn't close below, and you would still be in that trade regardless of whether you use my trailing ATR stop or a moving average stop. Again, I just wanted to share that with you. A moving average by its very nature trails behind and can be a very, very effective trailing exit. Obviously, depending on your trading style, if it was more medium term like me, you wouldn't be using something like a 5 or an 8 period moving average, because that will literally sit on top of price and therefore won't give you that space and that gap and allow that trend to move back and forward. Just wanted to share with you one more thing on this, and that is how we can use moving averages to greater effect. If you have two possible trading opportunities, and we'll call those trade A and trade B, and your primary trend was heading in the direction that you wanted to go, but what I refer to as the parent trend, so the longer term trend, is not heading in the direction you're going, you'll have a much lower probability of success compared to trade A, where everything is in alignment. And I'll come back to this as an example. Just get rid of my trailing ATR stop. This is a good example because it's a really solid trending stock. If you were to trade every single time that price just declined a little bit, like this, and down here, and so forth, and I know there's a setting where I can keep the drawing mode on. I just haven't obviously put it like that. If you were to compare those trading opportunities, and they're against the sort of overall trend, and we could draw up another one down up here as well, compare those to the opposite, and that is this move here, that one here, and all this one here. Compare them. You will find the short-term trends here, which are in alignment with the medium-term trend, simply go further and go for longer, and therefore present you a greater probability of success. That's all I mean when I'm talking about trend alignment. So yes, you may very much focus on your primary trend, and that absolutely is important because that's the way you want to trade, but don't be shy. Always consider the parent or the more, medium or the longer term trend above that. And that's why I have this trend ribbon down the bottom here on all the charts that I look at. And you would have noticed that on the indices that I've had, this trend ribbon down the bottom, and on this very good trending stock here, I've got my trend ribbon along the bottom, and this is a longer term trend than the one I've shown you there. So that's always just keeping an eye, and I have, good and bad, or I'll put long or short, or leave it alone. You can put in whatever you want there. And for those who don't know, and I hope you do, this trend ribbon here is part of what I refer to as probably the most underutilized component in Metastock, and that's the expert advisor. And whilst I love the Explorer and its ability to scan through lots of securities very quickly looking for your criterion, I love the expert advisor being able to look for so many different things on any individual chart you're looking at. So this is part of the expert advisor. It's called the trend ribbon. To me, it's a very, very good visual just check on what's happening. So that's all that is. And that's always looking at the more medium term trend. So even though I'm looking at, what's happening here in the the last, red's fine, the last 3 months or so, this one here. So what I'm looking at here is price above, moving average going up, and I've got a green down here to go long. So it's all these things being checked for me to simply present the greatest probability of success. Of course, never any certainty. All I'm looking for is probability. That's all I'm looking for, probability. Okay, as we approach the end of the hour, I probably need to think about heading back and handing back. So remember, just early on, I just went through the indices just to give you a bit of an overview without telling you what you don't already know. But just applying a couple of different things, looking at number of highs versus lows, and right now it's considerable, the difference. Also looking at that volatility percentage indicator and just using that as a measure of risk, potential risk, and whether that's something you want to avoid, and get you out of the market for a period of time before things settle down, which they will at some point. This is not, for the rest of time. They will settle down, and maybe it's just a great opportunity to move away or step away, but of course that's your choice. And then I just wanted to show you a few things with moving averages, and hopefully one or two things you may not have ever seen before, despite how common moving averages are. Well, with that, I thank you again. Thank you for your time this morning or this afternoon or this evening, wherever you may be. I appreciate it. It's been my pleasure to be with you. And Jeff, with that, I think I will hand back to you. Thanks very much for the time and the opportunity.
To see the presentation. We're having some audio issues that we're just trying to figure out over there, but that was a great recap, Stuart, and I really appreciate you for coming in and doing it. Let me go ahead and turn the presentation back over to me. Stuart did a really, really good job of talking about kind of the systems that he's developed for Metastock, and it does have the trade launch systems. The 2.0 is the version that we currently sell. And that does include the 3 expert systems, the scanning capabilities that he talked about, the trailing indicators, the reversals, includes all of that. And there was one part that I wanted to highlight, and so I'm going to do that. And so let me go ahead and kind of show you one of my favorite features of the trade launch systems. Of course, if you're familiar with the Metastock add-on, you are aware that it includes like scanning. They usually include expert advisor. One of the things I like about trade launch systems, and I ran a little bit of an exploration today, and this stock, Activision Blizzard, came up. Okay, and so here we can see kind of that it's been in a long phase for quite some time. Here you've got that buy signal that occurs on the chart. And here's what I wanted to kind of point out in terms of the expert advisor. So I'm just going to go ahead and kind of scroll in a little bit so you can read this along with me. And in this, the manual goes through and tells you exactly how to put in exactly what size of an account you want to trade, your risk parameters, and you can do that using like an indicator that actually exists in the program. Once you've got that set, it's going to kind of reference that and tell you exactly how much you should be buying. So I got this long signal on Activision Blizzard. If I was going to go ahead and take advantage of it, it's going to tell me that assuming an estimated entry price of 62.55, the optimum position size for trading this equity is 303 shares for a total consideration of $18,000 and not $18,900. Okay, using a stop loss criteria, your initial exit price would be $55.95, which represents a 10.5% drop in the share price. The estimated risk for this trade would be then $19.99 or 2% of your float. So based on that, based on kind of the things that you go in and put into the add-on, it's going to get really, really specific about where your stop losses should be placed, how many shares you should buy. And I just actually think that's really, really cool. So it's been a very, very popular. There's 3 different systems: altitude, ignition, and slingshot. There's a total of 28 indicators that are available and 8 explorations. What we're doing, and this is, you might have been to a couple of our classes that we call our enlightening classes, or our enlighten classes. We are actually running live training with Stuart McPhee. And so the thing that I kind of like about this one is he's going to cover quite a bit of things that are kind of like about like trading process and development, technical analysis, risk management, trading mindset, using his add-on. And so it's a total of 5 classes. We do these classes. What we're doing is we'll create these classes. When we create these classes, we create them live. So we go in and we do a webinar. And our plan is to retail this particular training series as an enlightened product for $799. So, and he's basically going to give you 5 full dedicated lessons in terms of how to set all this stuff up. And it's a fairly broad-based class. And if you've gone to an enlightened class before, I get just good feedbacks from them. We've done some with Rahul Mohindar. We did some with Steve Bigelow about a month ago, and we really try and provide a very, very high value. So what our offer is today as part of the webinar is you can get a combo. You can get the Trade Launch Systems 2.0, and in addition to that, you can get the training that we just talked about, all 5 sessions. Normally, if you just purchase those separately from our website, it costs you about $1,298. Here at the webinar, we're going to do that for $599 as a one-time cost. Okay. So there's a couple of different ways you can take advantage of that. You can go to metastock.com/tradingxltc. You can give us a call at 800-882-3040, or you can visit us online at metastock.com/saleschat. I've had an opportunity to participate in all of the enlightened training that we've done so far, and it's all been great. It's all been really, really good. Literally, for the cost of one really good trade, if it helps you find one really good trade, this will be paying for itself. So $599 is the cost. That includes the add-on. That includes all 5 sessions of the training. And again, you can take advantage of that at metastock.com/tradingxltc, or give us a call, 800-882-3040. So I hope that's helpful. I want to say thanks again for Stuart for coming and spending about an hour today talking to us, and after what's been a pretty rocky market lately. And I want to thank you for coming. I hope you learned something. I hope it was helpful for you. And as always, we'll see you at the next one. Thanks.